Alibaba stock is up 95% year to date. This is a stock that I've been talking about on my channel for the past 2 years, and it has actually become my biggest position. So far, things are going very well as I am up 105%. So in this video, I am going to do an in-depth analysis of the company by looking at the financials, the forecast, the balance sheet, using a DCF model to calculate the intrinsic value of BABA to determine whether or not this company is still a great buy today. Alibaba's revenue was growing very nicely from 2016 to 2022, growing at an average of 30% per year. However, as the company is now larger and larger and it is more difficult for them to grow, the company is now growing between 5 and 10%. And their revenue is currently 1 trillion Chinese yuan, which is around 140 billion USD. And analysts are expecting them to keep growing revenue very nicely at around 6 to 10% over the next 3 years. If we take a look at their net income, it took a big hit in 2022. However, it has nicely recovered since then. It is now back at all-time highs. However, if we take a look at their free cash flow, it has taken a big hit in the past 3 years. There are two main reasons for this. The main reason being is that Alibaba is planning on spending a lot of money on AI in the next 3 years. And reason number 2 is because, as you can see, they are buying back a ton of shares over the past 3 years. Now, this is very positive for investors as you own more on the company and you are sharing the profits of the company with less people. And in terms of EPS, analysts are still expecting a lot of growth from Alibaba, growing at an average of 16% over the next 3 years. And as we have seen with net income, their margins took a big hit in 2022, but it has nicely recovered since then, and they are currently doing 14% profit margin. Then, in order to calculate the intrinsic value of Alibaba, I use my spreadsheet. This tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And as you can see, the intrinsic value according to my low assumptions is $121 per share, middle $172, and high $267. And the stock is currently trading at $165 per share. And therefore, this means that if my low assumptions occur, you're going to make a 4.5% annual return on your money, middle 10.7%, and high 19.1% annual return. So according to my DCF model, the stock is currently fairly valued. And I believe my assumptions are reasonable as I have the company growing revenue between 5 and 9% over the next 7 years, averaging a profit margin and free cash flow margin between 12 and 18%, and I assigned the P and price to free cash flow at the end of the 7 years of 16, 18, and 20. If you want to make your own assumptions, I'm going to leave a link to the spreadsheet down below. It is super simple to use as I've done all the calculations in the background, so you only need to input your assumptions. By the way, these returns include the dividend because it comes from free cash flow and net income, so we cannot double count it, and it has a current dividend yield of 0.63%, which is around $1.05 per share annually. Moreover, Alibaba has a fantastic balance sheet as they have 58 billion in cash and only 35 billion in debt, which is nothing for a company that has a market cap of 370 billion, so they can use their cash to buy back more shares or spend in AI. In terms of my position, I am personally not going to add more because I believe the company is fairly valued and it is already my largest position. Moreover, if we take a look at the valuation ratios, they are currently trading at a P of 19 and a forward P of 20. So I think the company is fairly valued and not clearly undervalued as when it was below $100 per share. However, I do think that we could see the stock back to all-time highs at around $300 in a couple of years. I hope you found this video valuable. Let me know what you think about Alibaba stock in the comments, and I'll see you in the next one.